Good morning and welcome to Power Breakfast. I'm Pavitra Parekh. Those were all of the top headlines that we're tracking this morning. So clearly we have a lot to get to. But once again, we're starting off the day with a weakish handover from Wall Street. And on the back of that, you have all of the Asian markets which are trading with some cuts. So declines this morning are actually led by the Korean markets, which are down 0.8%. Hang Seng Taiwan are up on your screen. No big move there. Taiwan is down around 0.2%. Hang Seng is absolutely flat right now. But some of the other markets, so whether it's the Shanghai Straits, both of those also seeing some cuts. So Straits is down around 0.7%, Shanghai around 0.4% in the red. So that's what's happening across Asia. It's also pulled the SGX Nifty up for you now, and it is indicating a negative start for our own markets. We're currently around 40 points low on the SGX Nifty, but there has been a sharp downtick in the past couple of minutes as well. So that's what's happening as far as Asia goes. But let's also talk about the US markets now. Wall Street ended Wednesday's trading session lower once again. So the Dow Jones lost around 28 points. The S&P 500 was down around 10 points at the close, and the Nasdaq Composite closed just around 9 points lower. You have all of those figures on your screen. But sticking with the US, one big cue that came through was the minutes of the Fed meeting, of the last Fed meeting that came through yesterday. So CNBC's Steve Leisman filed this report with all of the highlights.
Minutes of the Federal Reserve September meeting showing that many participants stressed the need for the Fed to keep tightening, quote, even as the labor market slowed. They said ongoing rate increases were appropriate, and the cost of taking too little action outweighed the cost of doing too much when it came to fighting inflation. Once a restrictive level on the federal funds rate was reached, there was general agreement that it was appropriate to maintain that level for some time. A sizable portion of the economy, Fed officials observed, had yet to show response to tightening, even while some of the interest rate sensitive sectors had showed quite a bit of weakening. Inflation was said to be unacceptably high, the labor market very tight, and inflation was declining more slowly than had been anticipated. Maybe a few nods to the dovish side, but just very subtle nods. Several said the Fed needed to calibrate the pace of tightening with the risk of an adverse effect on the economy, and it would be appropriate at some point to slow the pace of increases, though not necessarily telling us what that level would be, where the Federal Reserve would stop. A few others here. Inflation pressures were seen gradually receding in coming years, and the uncertainty was high in the economy or in the economic outlook, but there were risks to the upside when it came to inflation. They said a wage price spiral had yet to develop, but it was seen as a possible risk, and risks to growth were generally to the downside, mostly from global headwinds like a European recession, a slowdown in China, as well as the Russia-Ukraine war. One other note here, the Fed staff did say liquidity conditions in the Treasury and mortgage markets, quote, remained low. You know, we've been talking a lot about that liquidity story here. So pretty much a hawkish Fed, reflecting the statement, reflecting the press conference of the Fed chair, with just maybe some additional concerns and commitment to keep rates high even as the labor market slowed.
All right, those are all of the highlights from the Fed minutes which were released yesterday. But let's also bring in some opinion from, on the Fed minutes that came through. This is from El Arian of Allianz, as well as Mike Wilson of Morgan Stanley. Listen in.
These minutes are as expected to somewhat, I don't want to overdo it, somewhat more hawkish. What the minutes do well is balance the inflation battle with the growth and job challenge. What they don't do well, and what the Bank of England has reminded us we have to keep an eye on, is bring in the financial stability challenge. And that's what's missing in these minutes. There's a passing reference to liquidity in the Treasury market, but that's about it.
We're very focused now on the path of earnings, right? This is the second part of the fire and ice narrative. And, while the Fed is still critically important to asset markets, we don't think there's an imminent pivot coming anytime soon in terms of like a true pivot where they not only pause, but really start cutting rates. We think that will come when it becomes apparent that we're either in a recession or there's some sort of, stress in the financial markets that the Fed has to react to. So in the meantime, what we're going to do is we're going to focus on what we do best, which is forecasting earnings a year out. And on that score, unfortunately, our models are pretty pessimistic.
All right, that is some important opinion that we're tracking, but that's everything that we're looking at globally. Let's talk about all of the cues that you should track as we get into a fresh trading session. Our research team is here with us. Nigel, Vahishta, as well as Vivek all join us to run us through the trade setup this morning and some of the individual stocks that you should keep on your radar as well. Guys, a very good morning to all of you. And Vivek, let's bring you in first. Once again, the cues really are not supportive as far as global markets go.
Well, absolutely right. It appears to be another subdued handover as far as global markets are concerned, as well as the Asian markets. The U.S. markets continue to decline, both on the back of the Fed commentary that we just highlighted, and also worries continue to surface. Today, there's a very important data point of the inflation data point as far as the U.S. Economy is concerned, and that is something that the markets are looking forward to very keenly. When you're talking about European markets, too, took quite negative cues, and European markets, too, ended in the red. When you're talking about crude prices, despite the fact that, there was such a significant cut announced by the OPEC Plus, crude prices have cooled off from the surge that we saw. Crude Brent is down a little over 2% last evening at around $92.3 a barrel, and NYMEX too fell down over 2.5%. When you're talking about the Indian markets along with Q2 results will also take cues from very hot inflation data that came in for the month of September, above what the street was anticipated, and the unexpected contraction that came in as far as the IIP data is concerned. Asian markets are trading in the red, and SGX Nifty 2 is indicating a gap down start as far as the Indian markets are concerned.
All right, Vivek, thanks a lot for running us through all of those cues. Let's talk about the individual stocks that you should watch out for. Vahishta has that entire list, and Vahishta, it could be a lot about tech once again today.
That's right, Pavitra. It is a lot about tech. The first stock is Wipro, when the constant currency revenue growth has come in at 4.1% quarter-on-quarter and 12.9% on a year-on-year basis. The Q3 FY23 guidance has come in modest at 0.5 to 2%, though the attrition, which has come in at 23% in the past quarter, has eased for the second quarter in a row. The next one is HCL Tech. Again, the results. Constant currency revenue growth has come in at 3.8%, which was very much in line with the estimates. And the company has raised the FY23 constant currency revenue growth guidance to 13.5 to 14.5, which was earlier in the range of 12 to 14%. Next is Adani Wilmar, wherein there's a business update. The revenues are expected to grow in low single digits on a year-on-year basis in Q2 of FY23, and the company has said that they have been successful in passing on the benefit of low prices to customers in a bid to protect their market share. Next is Panacea Bio, wherein Serum Institute has sold 2.2% stake on the 11th of October and now hold 7.63%. Sterling and Wilson has two updates. First is they've won an order of approximately 2,000 crores from NTPC REL for the solar PV project. And the next is their Q2 result, wherein the revenues have come in at 313 crores versus 1,400 crores in the past quarter. Maharashtra Seamless, there's a board meeting on the 17th of October to consider a bonus and split. And in terms of results today, we have Angel One, Cyient, Infosys, and Mindtree.
All right, that is a long list, Vahishta. Thanks a lot for running us through all of that news. Finally, let's bring Nigel in, and he's looking at all of the cues from the futures and options space. Nigel.
Well, morning, Pavitra. Yesterday had a bit of a relief rally, and that was good to see. The FIs at the end of the day, they sold roughly around 500 crores, but that's par for the course. The bulls seem to say you sell 500-600 crores, we're not too perturbed. The problem is when that number goes to 1,500 to around 2,000 crores. On the F&O side of things, yesterday you saw some bit of unwinding on the Nifty Futures. So that told you there was some short squeeze out there. While the Nifty Bank continues to hold strong, there appeared that there was some long addition out there, and that perfectly ties in with what the FIs did. After a long while, they added longs big time, close to 9,000 contracts, which is quite encouraging. And there were the first signs that there was some short covering that we saw out there. They continue to remain net short on the index, which may not be such a bad thing if this market can slowly move towards the 17,300 odd mark. On the index option side, well, they bought puts. In case things go wrong, well, they have some protection on the downside. But for me, the biggest positive, which tells me the bulls are putting in a fight, is that they wrote puts big time, more than 60,000 put contracts. Maybe there is some sort of a base at lower levels is what my interpretation is. 16,900 put, 17,000 put, both of them fairly active. And the 17,000 put, that gives some sense that maybe the 16,950 mark could hold out in the near term, which is, the low end of the range till around 17,500 odd. Last couple of days, we have bounced, in fact, from that particular level. The important level to track, well, you'll get excited once the Nifty gets past the 20 DMA. On the downside, the 200 DMA, well, that serves at a bit of a support. The Nifty Bank, that's a crucial one in there. Yesterday, it gradually moved towards that 50 DMA. You wanted to cross that to get more bullish on it. The SGX Nifty is suggesting a bit of a pullback. Maybe you get a little deeper pullback. Risk reward could favor the bulls. Back to you.
All right, a little bit of a pullback. So let's see how we move from there. Nigel, Vivek, as well as Vayishta, thank you very much for joining us and prepping us into Power Breakfast. And the big data point that came through for our own markets yesterday was that India's consumer price inflation has gone up to a 5-month high of 7.4%. This is for the month of September from 7% that we saw in August. This is the 9th straight month of retail inflation breaching the RBI's target band. And meanwhile, India's factory output also contracted by 0.8% in August. So Lata is here now with all of her analysis and how she's looking at these numbers. But Lata, this really does not look good at all.
At the outset, it's a bit of a negative that inflation is higher than what the street was expecting and growth is lower than what the street was expecting. But it is only marginal. I mean, it's not disastrous. 7.4 is the number compared to CNBC-TV18 and everybody's poll of 7.3%. The sad part is that the upside has come largely from food. I mean, 8.6% rise and very, very basic food items. Cereals and veggies, double-digit inflation in both of them. So that is a bit of a worry, but it was not entirely unexpected. The worry really will be how October turns out as well, because there have been a delayed withdrawal of monsoon. And if it continues in October, then people will be a little worried that the Reserve Bank targets won't be met. But more important, core inflation, which is you take away the volatile food and fuel items, even that is 6.1%. On expected lines, but that's above 6%. That's the point I'm making. And as you said, the 9th month, this was always known. For 9 months in a row, the MPC has not been able to keep inflation between 2 and 6%, which is their band. So they will have to meet and draft a note to Parliament explaining why they failed in keeping their mandate. This could be, preying upon them in future MPC meetings. Oh, we have to deliver. And so there are economists who have moved from an expectation of a 35 basis point hike in December to even 50 basis. I mean, there's slight upward bias to inflation and therefore interest rate expectations. On the growth front, IIP at minus 0.8 was nobody's guess. Everybody was in some degree of positive. Pulled down, we knew already that the core sector numbers were bad for the month of August. We had an advance number coming in on 30th September. Consumer durables and consumer non-durables. I mean, 10% contraction in consumer non-durables ties in with the fact that, remember, most of the FMCG updates were that it is barely mid-single digit growth. So it is looking like there's problem at the bottom of the pyramid. I would worry a bit on growth.
All right, Lata, thanks a lot for taking us through all of those numbers and your analysis on the same. But with that, let's also move on and talk about some key earnings which came through yesterday. HCL Tech was the big one. It reported a good quarter. Revenue in constant currency terms was up 3.8%. This is completely in line with guidance of 3.5 to 4%. The EBIT margin also inched up. It went up 100 basis points, so it's at 18% versus the guidance of 17.4%. But what came as a positive surprise is that the company has raised their revenue guidance to 13.5 to 14.5%. This is versus the 12 to 14% earlier. The company has also gone ahead and they've lowered the upper range of the FY23 margin guidance to 19%. This is versus the 20% that we had earlier. So let's hear it out from the management, MD and CEO C. Vijay Kumar, on their performance.
Margin performance has significantly improved. We did very well. We posted an EBIT of 18%, which is in line with our desired recovery plan. It's a result of significant operational efficiency measures coming to fruition. We've got good billing rate improvements for all the higher-end services that we are delivering to our customers. We remain very positive of our near-term growth and the medium-term growth. This confidence is coming from the booking that we've had in the first half of this year, and also the quality of pipeline that we have for the remainder of the year.
All right, remain positive on near-term growth. That is the word from HCL Tech. But Wipro was the other one. It reported a largely inline set of Q2 earnings as well. Constant currency revenue came in at 4.1% and the margin was at 15.1%. The guidance, however, at 0.5 to 2% is quite modest. This is for Q3 and is lower than the estimate of 1 to 3%. Here's a word from the management on why they adopted a modest guidance for the coming quarter.
In a market condition where uncertainty exists, and I think it's true for most of the sectors across, Europe and America. We just felt the need to be cautiously optimistic. And we will continue to observe the evolution of the market. For now, the demand continues to be strong, and certainly, if we look at the volume of deals to close in Q3, we are also optimistic and positive about the fact that we can deliver another strong quarter in bookings.
All right, that is Wipro management on their Q3 guidance. But with that, we have to get into a short break here. When we come back, we're tracking all of the cues from the commodity market, so stay tuned for that.